In chapter 6, we will look at why there's intra-industry trade. Intra-industry trade is trade in similar goods. So previously in the Heckscher and Olin model and the Ricardian model, we looked at inter-industry trade. So trade between different industries, different sectors, and different goods. Now, in this model, increasing returns to scale model with monopolistic competition, we will see that there is trade in similar goods, for example, golf clubs, because these goods might be similar, but they are not perfectly homogeneous, which should suggest that there is some monopolistic power that the producer has in its specific market. And we will see that this is a reason why there is goods trade in the same industry, for instance, golf clubs or motorcycles. Second, we will see that the reason behind it is that when you assume increasing returns to scale, the country's firms would like to take advantage of increasing market size by also, if you like, taking a hold in the market abroad and thereby increasing the market size. When you have an increased market size, you increase output, and with increasing returns to scale, this lowers average costs. Once average costs are lowered, this can be passed on from firms to households. So the benefit of trade here results in lower, if you like, lower prices to consumers and households, plus a increased variety in products. Now, there is, if you like, some costs also to trade, if you like, this intra-industry trade, namely when there is competition from abroad, from the foreign country also taking a part of the home domestic market. Some firms cannot compete at the lower cost and they have to exit the market, and therefore the workers employed and the resources employed in that firm or firms that exit the market will become unemployed, and there is some short to medium run adjustment cost that has to be faced by the country. In the long run, one would assume that these now unemployed resources, including workers, can adjust and find a new job, but in reality, the adjustment doesn't happen instantaneously. So this is what we will study in this chapter, in increasing returns to scale combined with monopolistic competition. In this lecture, we move on from the traditional models of international trade, that is Ricardian and the Heckscher and Olin model, towards the more advanced and more recent modern models of international trade. Specifically, in the previous models, we looked at explaining trade between countries that takes place between industries, that is inter-industry trade. In the following lecture, as well as the lecture thereafter, we look at intra, that is within the same industry type of trade. So to make it even more clear, in the previous Ricardian model and the Heckscher and Olin model, there was an export, for example, of one good, be it capital intensive, for example, to the other country, and the other country would export a labor intensive good. So that you have, for example, cloth and cars. These two goods are being traded, and this is inter-industry trade. That is, there is trade from one country sends goods to another country that is from one sector or one type of good, and in return receives trade from another sector. So that is inter-industry trade. Now we move on to intra-industry trade, which is the focus of this chapter. Specifically, we look at the first question: why do countries export and import similar goods, so goods that are classifiable into the same industry. Then, how much do consumers benefit from having products available from many countries? So this refers to product differentiation. And do all firms gain from having access to larger markets? And this relates to the point about monopolistic competition. And if you just look at the headline or the title, you can see that increasing returns to scale is in contrast to the previous models, which were assuming constant returns to scale. And previously, we were assuming perfect competition, and now we assume monopolistic competition. So that is why the title of this chapter is such. So bear that in mind as we proceed. So in chapter 2, we looked at data for US snowboard imports and found that the United States imports this product from a host of different countries. Now we look at another example, golf clubs, that the United States imports and exports in large quantities to illustrate how a country can both buy a product and sell it to other countries. So this is referring to the intra-industry trade. And intra comes from ancient Latin and means within. So inside, intra-industry trade. Intra-industry trade. So this is what this lecture and the model that we will be discussing will be about, intra-industry trade. So on this table, you can see the imports and exports by the United States of this good, golf clubs, from 2014. And you see the country from and to which it is exporting and importing, respectively, the value of the imports, the quantity, and the average price. So the value of import relates to relating the quantity of golf clubs into a dollar figure by using its price. Now, if you go down the list, you can see that there is a large number of countries from which the United States is importing countries, including mainland China, Taiwan, Vietnam, Japan, Mexico, Thailand, and so on. And you can clearly see that there is at the top quite a density of the, if you like, regions of the world from which the United States imports those goods. As the eagle-eyed among you have already noticed, there's a small typo here. This should be exports, not imports. So this should be exports. And then you can see that there again is a large number of countries from which the United States, or to which the United States exports countries. And here the top country is Canada, but some regions that have appeared in the previous slide when looking at the origin of imports or the destination of imports, some of the countries show up in these ranks again. So this would suggest, as it says in the bottom of the slide, that this is indicative of intra-industry trade, that the United States is both importing golf clubs and then also exporting them, or vice versa, exporting and importing them. And interestingly, you should compare the value of imports, the value of exports to the value of imports by going back to the slide and see whether the United States is a net importer or a net exporter of golf clubs. So if you have compared the two slides, you can see that exports are less than imports, which would suggest that the United States is a net importer of golf clubs. You can compare this by looking at the value of exports, and again, you can fix the title of this column, that the value of exports is less than the value of imports. Also note that the average price is 104 of the exported good that leaves the United States, and the average price for the imported golf club is 26 if you compare it to the previous slide. So it's 26 compared to 104. So it seems to be the case that on average, cheap golf clubs are imported and expensive golf clubs are being exported. And if you look long enough at the table and then you relate this basic statistics to the destination countries, for example, Canada, Japan, Korea, Australia, Hong Kong, China, United Kingdom, Singapore, etc., these tend to be, at least the top countries or regions, quite high on the per capita income range. So these countries perhaps could afford to purchase those golf clubs which have a price tag of on average 104, compared with the $20 golf clubs that are being imported from countries that have a perhaps lower per capita per head income level. So then we can ask ourselves, why does the United States import and export golf clubs to and from the same countries? So as mentioned at the beginning, we move from perfect competition, which was the assumption of the previous, more traditional models, to monopolistic competition. Monopolistic competition is in contrast to perfect competition, because in perfect competition, a firm cannot affect the price of the market, and it has a insignificant market share and cannot really control the market. Whereas monopolistic competition allows for firms to have some effect on the price. In addition, as is mentioned below, in a perfectly competitive market, the goods produced are homogeneous. That is, they are indistinguishable. So think about, for instance, a perfectly competitive market where the brands in which, if you like, which exist in this market, make hardly any difference. And to the consumer, the good being produced is roughly the same. Of course, in reality, in every market, goods are never homogeneous, and this assumption, the assumption of the model should be evaluated on the basis of not whether or not it is matched in reality, but whether or not now assuming imperfect competition is more useful for answering the question that the model has been constructed for. So in this chapter, we assume that goods are differentiated, means that the consumer can see the differences in the goods and attaches, if you like, some value to the different goods that are being produced. Whereas previously, two firms or three firms in the same market, the consumer is indifferent between buying, for example, paper from firm 1, 2, 3. But in the imperfect competition model, the consumer is not perfectly indifferent. He or she does not see these goods as homogeneous, as completely identical and perfect substitutes. And in that sense, there is some product differentiation and therefore also some amount of market power. And therefore, when we speak of some market power, then the market structure will be described as being imperfectly competitive. There is still competition. There's not a single firm, which would be monopoly. There's also not a few firms, which would be oligopoly. But it is, if you like, a mixed market structure, which is imperfect competition. And if you want to know more about these market structures, you can look up in an encyclopedia the taxonomy of market structures. So in this chapter, we examine this monopolistic competition model. Then secondly, we look at the choice of consumers and the prices before and after trade between two countries. And then we look at gains from trade. And then fourthly, we look at an application to Mexico and the US under the North American Free Trade Agreement, NAFTA. And finally, we look at the gravity equation that suggests that the countries that have a higher GDP or that are geographically close will trade more. So the notion of differentiation of goods is that they are not homogeneous or not identical. And this suggests that when goods are not identical, firms can influence the prices that they charge. Typically, under perfect competition, firms are price takers. But under imperfect competition, firms are, at least to some extent, price makers. In that sense, they can influence the price. They are price makers, whereas under perfect competition, they're price takers. Monopolistic competition has two characteristic features, namely that the goods being produced are differentiated by different firms, so the consumer can distinguish between different goods from different firms, even within the same sector. So within the cloth sector or the car sector, the consumer can distinguish between a Ferrari, a Porsche, a BMW, a Mercedes, etc. Secondly, firms enjoy increasing returns to scale, which suggests that AC, that is the average cost for a firm, falls as more output is produced. Constant returns to scale, in contrast, suggest that the average cost does not change with output. Increasing returns to scale means that the average cost for a firm falls as output rises. So as output rises, output here is the sense to which the scale of operation is akin to the output being produced by the firm. So when you increase output and average cost falls, then you can say that this production technology is characterized by increasing returns to scale. Returns to scale here also, you have to also understand why does it refer to returns. You can think of this as when you input the factors, capital, labor, etc., what you get back, so what is being returned to you via the production function, via the technology of the firm, is the output. So increasing returns to scale refers to that the output actually exhibits falling costs, falling average costs. The greater the firm, the larger the firm, the more output the firm produces. So here a slide on recapping some important terminology. Intra-industry trade, again, is trade, import exports, in the same industry. The gravity equation, secondly, suggests that the larger a country, as measured by gross domestic product, would suggest that the countries should trade more with each other. Gravity here is in terms of the weight of the economy. Thirdly, monopolistic competition as a model allows us to understand the effects of free trade agreements when free trade occurs among a group of countries. And then finally, duopoly versus monopoly will be compared and contrasted in the next slide. Here we see the case of a monopolist, which depicts the price and the quantity. And in blue, you can see the demand curve. Demand is sloping downwards because as price falls, the quantity demanded increases. And then second, you notice that the marginal cost is flat as a curve, which suggests that the quantity being low or high of the producer does not affect the marginal cost. So the monopolist can produce at constant marginal cost. The marginal revenue curve is sloping downwards, which suggests that at the low quantity, the marginal revenue is quite high. But as quantity increases, the marginal revenue drops. On the right-hand side, you can see that it is suggested that the extra revenue earned from selling one more unit is described as marginal revenue, and this falls as more units are being sold. The monopolist chooses the intersection between marginal cost and marginal revenue, which is highlighted here as the intersection just below the point A. And that is the reason, therefore, is that any point at which the firm produces at a quantity higher than QM, the marginal cost will be higher than the marginal benefit, the marginal benefit here being denoted by the marginal revenue. So therefore, it would not make sense to produce at a quantity that is higher than QM because the marginal cost would exceed the marginal benefit. Similarly, it would also not make sense for the profit maximizing monopolist to produce at a point below QM because there the marginal benefit denoted by MR would be higher than marginal cost. That means the firm should produce an additional unit of output at the margin until MR equals MC. And at that point, the price will be set at A. This is the monopoly equilibrium. And the price is at PM. Note that there is a large markup above marginal revenue that the monopolist can charge. And this is the extent to which this market is defined as a monopolistic market, where the price is higher than the marginal cost and marginal revenue intersection. Clarify why this chart is one of a monopolist. Note that the markup is the difference between the price and the marginal cost. So, for instance, if we have a markup of 0, then the production would take place at this point, where quantity would be much, much higher than at QM. So there, at that price, where price is lower than at PM of the monopolist, that would represent the perfectly competitive market. The perfectly competitive market would have a higher output where each firm is not able to charge a markup. And that is the sense to which a monopoly, a monopolistic market structure, restricts output from what is possible under a perfectly competitive market and actually reduces it to QM. So this distance between these 2 points is the reduction in quantity that is a direct result of the monopolistic power structure of the firm in the industry. And the monopoly can capture monopoly, if you like, profits here. You can think of this as markups, where it charges the customer a price PM that is actually higher than it costs to produce the marginal good. This is the extent to which there is monopoly profits, because PM prices are higher than marginal cost and QM is lower than what would be produced in a perfectly competitive market. Here we move on to duopoly, where there's not just one firm that is controlling the market, but 2 firms. Duo means 2 from ancient Latin. So as you can see on the right-hand side, it is said that when there are 2 firms in the market, they both charge the same price. Otherwise, one firm would be starting to undercut the other, and the other firm then would follow suit. So in that sense, both firms charge the same price. And here we assume that each firm faces the demand curve D divided by 2. So each firm in the duopoly has half market share. Then at price P1, the industry produces at Q1. So at price P1, the quantity produced is at Q1, and each firm produces Q2, which is Q1 divided by 2. And at point B. Note that the chart is just representative. It is not drawn exactly to scale. Then next, if both firms produce identical products and one firm lowers its price from P1 to P2, then all consumers will buy from that firm which has a lower price, and that firm that lowers the price will face the demand curve D and sell Q3 at point C. This is QC at point C. So if a firm deviates from P1 to P2 by lowering its price, it can increase how much demand there is for its good. Note importantly the detail here in the assumption. In this chart with duopoly, we assume that firms produce identical products. And then when one firm lowers its price, all consumers will buy from that firm which has a lower price. This will be in contrast to what we assume in the next slide, where we assume, in contrast, differentiated goods. So here, alternatively, we can make the assumption that products are differentiated. The firm that lowers the price from P1 to P2 will take some of the sales from the other firm, but not all. It will face a demand curve lowercase d at P2. It will sell Q4 at point C asterisk. C asterisk is lower than what would be the case under identical or non-differentiated goods. So in a duopoly, when firms produce products that are differentiated, that is not homogeneous, when a firm tries to undercut the other firm in the market, it will gain some market share, but not all. That is because the products that the firms produce are in the same industry, but they are slightly different. Think about this as, for example, the car industry, where there's a duopoly between, for instance, Porsche and Ferrari. If they are at the same price level and Porsche tries to lower the price, and typically it tends to be the case that Porsche cars are less expensive than Ferrari cars, then it will gain a market share, let's say in the luxury car market, but it will not gain the complete market share, as some customers are willing to pay a higher price for Ferrari cars, as they consider these to be differentiated from Porsche cars in the luxury car market. The assumptions underlying the monopolistic competition model are as follows. First, every firm produces a good that is similar but different from the good that the other firm or firms are producing. Each firm faces a downward sloping demand curve for its product and has some control over its price it charges. In that sense, it is a partial price maker, whereas in perfect competition, every firm is a price taker. In other words, the firm has some monopolistic power within part of the market. Second, there are many firms in the industry, so we do not as capital N, the number of firms, then D divided by N is the share of demand that each firm faces when firms are all charging the same price. And then if only one firm lowers its price, it will face a flatter demand curve of lowercase d. And that is, we assume, due to the differentiated nature of the goods in this industry. Third, firms produce using a increasing returns to scale technology. And as production increases, the average cost falls. Marginal cost is below average cost, and here it is drawn as a constant for simplicity. Typically, a marginal cost rises with an increase in quantity, but here marginal cost is just a flat line. Here is a numerical example of increasing returns to scale. And you see on the left-hand side the quantity, and see how variable costs, total costs, and average costs change as the quantity increases. At quantity 10, the variable cost is $100. And the variable cost is multiplying the quantity, the number of goods being produced, multiplied by marginal cost. And total cost is VC plus FC, variable cost plus fixed cost. Fixed cost I assume to be 100. So if we add fixed cost 100 plus the variable cost 100, then we get to 200. And the average costs are the total cost TC divided by the quantity. So the average cost is the cost, if you like, per unit of output, which is 20. Then if you look at the quantity doubling to 20, the variable cost is 200. The marginal cost is 10. As we've drawn it on the previous slide, it is constant, so it is still 10. It's not dependent on quantity. The variable cost is increasing because the quantity has doubled to 20, from 10 to 20. Therefore, the variable cost will also increase from 100 to 200. The marginal cost is constant, and if you double the quantity, therefore the variable cost should also double from 100 to 200. The total cost is variable cost plus fixed cost, which is 300. Then, if you calculate average costs, that is total costs of all production divided by quantity, you have 15. So 15 is $15 for this good that we are producing. So $15 is the cost of the product on average. And then if you continue to increase the quantity to 30, 40, and so on, you can see that the variable cost is increasing and the total cost is also increasing. But you see that the average cost is falling from 20 to close to 10. And if the price is charged above average cost, then a firm earns monopoly profits. Fourthly, firms can enter and exit the industry freely. Monopoly profits are zero in the long run. So here we assume that firms can enter if it is possible to make profits, monopoly profits, and more firms enter, they will lower the profits per firm. Profits for each firm end up being zero in the long run, just as in perfect competition. So this assumption relates to there being no barriers to entry to the market, and this allows the result that monopoly profits will be down to zero in the long run, as if there are profits to be made, additional firms will enter the industry. In the essence of any trade, the equilibrium in the economy will look as follows. The short-run equilibrium will be the same as in monopoly as under monopolistic competition. Namely, the firm chooses to produce at the quantity Q0, at which the firm's MR, marginal revenue, MR0 equals its marginal cost, which is that point here. And at that point where MR equals MC, remember MR represents marginal benefit, and if marginal benefit is equal to marginal cost, there's profit maximization. The quantity produced will be Q0 and the price will be set at P0. Because price exceeds average cost, the firm will make a profit. The profit to be made is denoted by this area, which is the difference in the price and the average cost. And this is the total profits that is being made by the firm in the market. Given that there are profits to be made, additional firms will be attracted to enter the industry. And the firm's demand curve initially is at D0, but it changes to the left and becomes more elastic at D1. So first, there's a change, that is the shift from D0 to D1. That is natural because if there's more firms in the industry, each firm, especially also the initial one, will be able to sell less, and there's less demand for that initial firm's product. That's the first change. Second change is there is a change in the slope whereby D1 is more elastic than D0. And here we are talking about the price elasticity of demand for a firm's good with respect to price. So we're talking about the price elasticity. A more elastic price elasticity of demand at D1 would refer to, for a similar sized price change, for example price reduction, there will be a greater response in demand, here's being an increase in the demand. So for instance, if you take the same change in the price, you can see that the increase in demand will be a little bit smaller at D0, so there is price elasticity that is less at D0 than if you take a similar sized reduction in price and you will see a much larger change in the quantity. This is the meaning of price elasticity of demand. And this suggests that as new firms enter the industry, when the firm that is existent in the industry lowers its price, it will have a greater responsiveness, a greater increase in the demand for its products because other firms are in the industry, and it can attract the customers from the other firms in the industry by lowering its price. So that is the reason for the elasticity becoming higher once other firms enter the market. The long-run equilibrium occurs in monopolistic competition as a scenario at quantity Q1, where the MR curve, MR1, the marginal revenue curve that is associated with the demand curve D1, equals marginal cost. So again, where marginal benefit equals marginal cost. At that quantity, the no trade price, P A for autonomy, that equals the average cost point at A. That means if average cost is equal to the price, at this point, profit is equal to 0. So in that sense, we have monopolistic competition. In that sense that supernormal profits are 0 in this competitive, monopolistically competitive market. Secondly, why we have a monopolistically competitive market, so why not a perfectly competitive market, is that marginal revenue does not equal price. So in a perfectly competitive market, the price is equal to marginal revenue, which means that however much a perfectly competitive firm is selling, it does not affect its marginal, it does not lower its marginal revenue. So the marginal revenue means that the additional revenue, that is what is coming into the pockets, if you like, of the entrepreneur or the firm at the margin, when you add an additional unit of output that you can sell, what is the money flowing into the pocket of the firm? That is just the price that is being paid by the customer paying that good. And that is the case in perfect competition, where marginal revenue equals price. In a monopolistically competitive environment, marginal revenue does not equal price, because the firm can do some price setting. It is a price maker. It can actually do some, if you like, price differentiation by looking at demand and setting prices depending on the demand and the relative willingness of customers to pay for at different prices. So that is the case in which this model is monopolistically competitive, because marginal revenue does not equal price. So therefore, hopefully it will be very clear now why we have these two components. On the one hand, competition, because supernormal profits are 0 as average cost is equal to price. First point. Second point, we have monopolistic elements in this market structure because the marginal revenue does not equal the price. In the long-run equilibrium, firms earn 0 monopoly profits, and there's no exit or entry. The quantity produced by each firm is less than in the short-run equilibrium. So the short-run equilibrium is at this point, and we still have no trade with the outside world. And in the long run, as more firms enter the market, the quantity produced by each firm, by a single firm, is less than in the short-run equilibrium. Obviously, because as more firms enter the market is more crowded, and overall, each single firm will produce less than previously as more firms are sharing the market. So we're producing as a single firm at Q1, whereas previously we were producing at Q0. With a greater number of firms and more varieties available to consumers, the demand for each variety, D1, is less than D0. So D0 is the short run demand curve. That is where just a few firms or one firm exists, which produces, for example, just let's say Porsches. But as more firms enter the market, there will be more different varieties of these cars, these type of luxury cars, and the demand for each variety will be less as the demand will be more diffused and spread over and distributed among these different firms in the industry. The demand curve D divided by NA shows the no trade demand when all firms charge the same price. So that is suggestive of the no trade equilibrium in the long run, that we are at A. At A, price equals AC, there is no profits, and quantity is at Q1. And that is the conclusion of the long run equilibrium without trade. And next we will open up the economy to trade. So in the short run equilibrium with trade, we assume that foreign and home as an economy are exactly the same. Same number of consumers, same production technology, same cost curves, same number of firms in the no trade equilibrium. Without any economies of scale, without any increasing returns to scale, there will be no trade. There will be no reason for trade. Under the Ricardian model, countries with identical technologies would not trade. So remember, in the Ricardian model, we just have labor, a single factor, and the countries have identical technologies. Think about this as the production function that we have written down. So each country is using the same production function, but one country is more productive than another. And in the Ricardian model, although it is the same production function, a parameter might be slightly different, making one country more productive than another, and therefore there is then, if you like, export or import of that sector's goods to the other country. However, in the Ricardian model still, if the production functions are the same and all parameters in the production function are the same, making the marginal product of labor and capital, or in this case in the pure Ricardian model, there is, if you like, no capital, just the marginal product of labor exactly the same in each country, there would be no point in trading, as each country is equally productive and there is no comparative advantage. In the HO model, in the hexagonal model, countries with identical factor endowments would also not trade. So in the typical hexagonal model setup that we looked at previously, countries have identical technologies, but they have different factor endowments. And although the production technologies are the same and all the parameters are the same, in, for example, the car sector, the capital and labor endowment will be different, and this would render one country, if you like, having a comparative advantage due to its endowments and relative endowment abundance compared with the other country, if you like, advantageous, such that it will export that good to the other country in which it is relatively abundant in. Now, in the Heckscher-Ohle model, again, if we have then this assumption of identical factor endowments, so the countries are identical in technologies and identical in factor endowments, there would be no trade. So then finally, under monopolistic competition, two identical countries will still engage in trade. So this is an interesting contrast. If we have monopolistic competition, countries which are identical will have a reason to engage in trade. And this is in contrast to the Ricardian model and in contrast to the Heckscher-Ohle model. When in Ricardian model, where productivity differences explain trade, once we take the productivity difference away, there's no trade. In the Heckscher-Ohle model, countries differ not in productivity, but in their factor endowment. But once we take the difference in factor endowments, relative factor abundance away, there will be no trade. Here, when countries are perfectly identical, there is still reason for trade. And this is what we will discover in the next few slides. So in the short-run equilibrium with trade, the number of firms in each country is denoted by uppercase N, A. The quantity demanded from each firm when all firms charge the same price, it's capital or uppercase D divided by NA. So first, we will consider each country in the long run equilibrium without trade, and then see what happens once trade opens and the number of customer doubles. Doubles because we have now two markets to which the firms have access to. And since there are twice as many customers and twice as many firms, the ratio stays the same. The ratio being the quantity demanded from each firm. The product varieties also double, available to each consumer in a country. And with a greater number of varieties available, the demand for each individual variety will be more elastic. And here, this is meaning the price elasticity of demand. So when trade is open, the larger market makes the firm's demand curve more elastic, as shown by D2, with the marginal revenue curve being MR2. The firm chooses to produce at quantity Q2, at which marginal revenue equals marginal cost. The corresponding price is P2. And sales at Q2 at price P2 yields the firm monopoly profits since the price is greater than average cost. So the firm chooses this point here where marginal revenue equals marginal cost, and this gives us the point at which the price is set at P2. And at P2, there's still monopoly profits since there is this gap between the price and average cost. Whereas previously, quantity was set at Q1 and the price was set at PA. In other words, opening up to trade reduces the price of the good and increases the quantity. Note that capital D divided by NA is the demand function when all firms charge the same price, whereas lowercase d2 is the demand curve of only a firm charging a price that is different from the rest of the market. So if it is the case that all firms charge a lower price at P2 instead of being at D2, the demand will not be at B, but at B bar, because there is a reduction in demand for the firm as other firms who also lower their price will get part of this market share from the other firm. The result thereof is that the price P2 is less than average cost, which is denoted here in blue. And if the price is less than average cost, then there is actually a loss instead of a profit being made by the firms. Resultant is a exit of firms. So some firms cannot sustain their business and therefore they exit the market. So as firms are making losses, some exit the industry, and this in turn will increase demand for the remaining firms and their products and decrease the available product variety to consumers. So now we have NT firms, which is fewer than NA firms we had before. And note that the amount of firms in autonomy is less than the amount of firms with trade. So we have a 2 here because we have 2 countries. And the amount of trade, so the amount of firms under the trade scenario, however, is less than the number of firms merely multiplying the autonomy, if you like, no trade scenario number of firms. In other words, the number of firms rises when you compare this to this. However, it is not exactly double the number of firms in the autonomy, autarky, non-trade setup. The new demand, uppercase D divided by uppercase NT, lies to the right of D divided by NA. In other words, there's more demand for a firm under trade compared with under autarky. So therefore, instead of being somewhere where price is below average cost, price now is at average cost. So profits are maximized for each firm producing a Q3, and monopoly profits are 0, as each firm sets its price equals to the average cost, and no firms exit or enter the industry. And in addition, you can also see that the price being set and the quantity being produced by the individual firm is actually equal to across all firms in the market, which is denoted by D divided by NT. So there's an intersection between lowercase d and uppercase d divided by NT. Compared with the long-run equilibrium without trade in figure 6.5, D3 has shifted out as domestic firms exited the industry and has become more elastic. So this is this curve D3, and there is a larger number of varieties in terms of number of firms with trade than without. So here, when we talk about varieties, we assume that each firm produces a somewhat differentiated good. So if we have a larger number of firms, we have a larger variety of products, as we assume that each firm produces a slightly different product than other firms. Compared with the long-run equilibrium without trade that we showed previously, the trade equilibrium at point C in the long run has a lower price, which is PW, and higher sales by all surviving firms. So we have a lower sales price and higher sales by all firms in the industry. So the gains from trade are twofold: a reduction in price, so cheaper products for customers, and this is due to the increased productivity of the surviving firms coming from increasing returns to scale. So as firms can produce more, we know that the average cost AC of production falls as Q quantity produced is increasing, so therefore a drop in price. Secondly, an increase in variety, so opening up the market to trade allows for a large number of firms to exist. Although there are fewer product varieties made within each country by fewer firms, consumers have more product variety because they can choose between foreign firms as well as domestic firms. So this result allows us to talk about more complex and more varied gains from trade as well as losses from trade. So there's adjustment costs associated with opening up trade because firms shut down or exit the industry once they face competition from the rest of the world. And the workers employed in those firms experience a spell of unemployment. And this is in the short run. In the long run, one could expect those workers to find new jobs, and presumably, under several strong assumptions, these costs are temporary. Obviously, to those workers, these costs might feel permanent, and might be devastating to lose their jobs. But from the model, if the adjustment is quick, then these adjustment costs are temporary. The only question is, how long is the short run? The short run might not turn out to be that short after all from the perspective of these workers. We will examine both short run and long run adjustment costs, and then we look at some evidence from NAFTA. The economist Trefler studied the short run effect of NAFTA with respect to Canada on employment and the long run effect on productivity and wages. He found that the decline in employment was quite large in the short run, as predicted by the model. Over time, job losses were made up or compensated by the creation of new jobs elsewhere in manufacturing. Productivity growth in Canada allowed for a modest rise in real earnings. So temporarily, there is a decline in employment, and over time, some of this fall in employment is compensated by increases in jobs in other parts of the manufacturing industry. And productivity growth increases real earnings, which would suggest there's some compensation. Obviously, the question is whether or not these new jobs that are being created are also, if you like, those workers that lost their job previously, or if it is just a reallocation of jobs to perhaps other workers. So next we look at the effect of NAFTA on Mexico. And part of NAFTA was a reduction in tariffs. And the result is a increase in productivity of maquiladora plants over and above the increase in productivity that occurred in the rest of Mexico. So for workers, however, there is a decrease of more than 20% in real wages in both agricultural and manufacturing sectors, despite the rise in productivity. And this is attributed to the devaluation of the peso during the financial crisis shortly after Mexico joining NAFTA. And 20 years after the NAFTA agreement was reached, the first, if you like, crossing of the border into the United States took place. So if you look at what is the effect on productivity and wages, on the left-hand side, panel A, we see that productivity for workers in the maquiladora manufacturing plants and workers in other plants in the rest of Mexico exhibit the following pattern of productivity increases. So you can see that the maquiladora productivity rises after some time much faster than the non-maquiladora plants, which is in green, after the 2000s. And real wages and income are seen in panel B. And you can see that productivity and income, real monthly income, is growing at a faster rate in the maquiladora plants due to the increased trade with the United States following NAFTA. So, as a side note, maquila, as you will have taken from the textbook, are a form of near-shoring, which is a subset of offshoring. And this nearshoring is a form of offshoring to a country nearby, and that is not necessarily as far or as distant as under farshoring, for example, from the United States to the Far East. Similarly, similarly in Europe, some northern or central European states might do nearshoring to countries with lower wage rates, such as Eastern Europe. Now, when looking at these adjustment costs, we can see also that farmers growing corn in Mexico did not suffer as much as was feared. So there, if you like, are some poorest farmers that if they do not want to sell the corn, they can consume it. And the government in Mexico also applied some subsidies to offset the reduction in income for corn farmers, which obviously would be outcompeted by the large and very powerful US agricultural sector, which operates with, if you like, machinery that is capital and is perhaps allowed to therefore produce corn at much cheaper prices than Mexican farmers. So there was a reduction in income for corn farmers, if you like. That is the sector in Mexico which was affected by the competition from imports of corn from the United States. The total production of corn in Mexico actually rose after NAFTA, and maquiladoras face increasing international competition that can be expected to raise the volatility of output and employment. So there are some downsides and costs that need to be discussed and borne in mind and quantified in each specific case, depending on what country and what kind of opening up to trade one is analyzing. So when looking at NAFTA's effects on the US economy, these have not estimated the effects on productivity of US firms. So the reason is that Mexico and Canada are only two of many trading partners with the United States. And a second source of gains from trade is the expansion of import varieties available to consumers. Now we will look at the long-run gains to consumers in the United States from this increased product variety and compare it to these costs, adjustment costs caused by the exit of firms and loss of employment. So if you analyze the effect on the US economy from NAFTA, there is a negative impact, and that led to large job losses in the United States as firms moved their production to Mexico. This is the argument and some evidence put forward by Bonnois. On the other hand, Posen, he adds to the debate by suggesting that there's positive impacts from NAFTA, for example, the consumer gains from low prices and the potential for job creation in the United States as US companies expanded in both countries. So the expansion of variety to the United States can be seen as follows. This is in several industries, from agricultural industry to the electronic industry. And from 1990 to 2001, export variety grew in every industry as US tariffs were reduced by NAFTA. So, for example, you can see that the export variety to the United States in agriculture increased from 42% to 51%. Similarly, in textiles and garments. In addition, there's adjustment costs in the United States, and one way to measure them is the employment as firms get shut down. And we can look at this at the TAA, the US Trade Adjustment Assistance provision, which helps workers in manufacturing that lost their jobs because of import competition. And between 1994 and 2002, about more than 500,000 workers, or about 58,000 per year, lost their jobs and were certified as being adversely affected by the trade and import competition under NAFTA. The annual number of workers displaced in manufacturing was 4 million, or 400, roughly 50,000, so close to 500,000 workers per year. The NAFTA layoffs of 58,000 workers would correspond to about 13% of total displacement, which is a substantial amount that is attributable to trade open up and trade liberalization. So, measuring the loss of wages of the displaced workers, we can refer back to chapter 3, where we learned that about more than half of workers laid off in manufacturing are re-employed within 3 years. And that is quite depending on your standard of judgment, but by some accounts, this is quite a long time, 3 years, as within 3 years, a lot of skills and human capital is being lost of workers that are not employed in the sector in which they have been working and which they have been trained for. Now, suppose that the average length of this unemployment spell is 3 years, which is quite optimistic because that is not necessarily the typical average. But if the average yearly earnings for manufacturing workers was $31,000 in 2000, each displaced worker lost $93,000 in wages, which is around 5.4 billion per year during the first 9 years of NAFTA. The estimated private costs are practically the same as the average welfare gains. However, at the same time, the gains continue to grow over time while the job losses are temporary and fall over time. But obviously, for those workers who are permanently replaced, the losses certainly are permanent. But here we evaluate it from an aggregate perspective, from a macroeconomic perspective of the country as a whole. In 2002, the NAFTA program was consolidated with the general TAA program, such that no data can be used that is specific to NAFTA afterwards. And under the consolidated program, there are still some limitations in addressing the needs of laid-off workers due to trade competition, such that the competition from imports might not be as well cushioned from this consolidated program compared with the more specific NAFTA TAA program. So there's two sources of gains. There is lower prices due to the rise in productivity from expanded output by the surviving firms, and also a higher product variety after trade, although some workers lose their jobs when firms exit in a country when it's facing import competition. So for the United States, a long run gain exists in increased product variety and fall in prices for consumers. And these gains are quite large and exceed the short run costs for Canada and the United States. However, for the poorer country, Mexico in this case, the gains were not necessarily translated into the growth of real wages for workers. Nonetheless, the real earnings of higher income workers in the maquiladora sector have risen, and they have been the principal beneficiaries of NAFTA so far. An index of intra-industry trade can measure the proportion of trade in each product that involves both imports and exports. When this index is 100, an equal amount of the good is imported and exported. And when the index is 0, it means that the good is either imported or exported, but not both. So the index of intra-industry trade is the minimum of imports and exports divided by imports plus exports divided by half. So looking at the data, this table shows for different products the intra-industry trade index, and you can see for vaccines the intra-industry trade is very high. Vaccines for things such as influenza and other, if you like, communicable or transmittable diseases, the intra-industry trade is very high. And for golf clubs, with which we started our discussion, the intra-industry trade is also high. And for products that are mainly imported or exported, but not both, for example, men's shorts or telephones or golf carts, these are either imported or exported. So there is more inter-industry trade in this product variety. Tinbergen looked at international trade from somebody who has studied physics, from a physicist perspective, and there, objects with larger mass or that are close together have a bigger gravitational pull. And from physics to economics, the gravity equation for trade suggests that it is a hypothesis that countries with larger GDPs or that are closer to each other will have more trade between them. And this is the gravity equation which we'll look at now. So with two objects M1 and M2 representing their masses located at d distance apart, the gravity force between those two objects, those two masses, is denoted by capital F G equals uppercase G times the product of the masses divided by the square of the distance. And the bigger the objects are, or the, if you like, more proximate, closer they are, the greater the force of gravity between them. So if the distance falls, the force is larger, and if the masses grow, then also the force increases. In case of trade, the larger the two, if you like, economies are, or the closer they are, the greater the amount of trade, would be suggested by this gravity equation. Translated to international trade, the mass of a economy could be represented by its gross domestic product, by how much it produces in a year in terms of value, and that is for each country, GDP1 and GDP2. And the distance here is just the distance between the two economies. And trade would replace the force in the universal law of gravitation, and it would suggest that trade should equal the GDP of a country multiplied times the share divided by the distance. And that is equal to 1 divided by the GDP of the world multiplied by the product of the GDPs of the two different countries. So the gravity equation suggests that countries which are larger, they export and import more. They export more because they produce more product varieties, and they import more because their demand is higher. The demand for the first country's goods depends on the relative size of the importing country and the distance between the two countries. So to measure the relative size of a country, that is the other country, the country number 2, we can use its share of world GDP. So this is the GDP of the second country divided by world GDP. And this is suggestive of the relative size of the importing country and the distance between the two countries. So if we plot trade between the US and Canada by state and provinces, we depict in figure 6.9 on the vertical axis trade in US dollar million, and on the right hand side the part of GDP that is either further apart or closer together between the US states and the Canadian provinces. So it would suggest that if you increase the gravity, that it is these provinces have respectively higher GDP or that they are closer together, there's an increase in the trade between them. And there is suggestion that, for example, when gravity is 1, the amount of trade between a province and a state is 93 million. So if we just look at trade within Canada between Canadian provinces, we can see that there is a positive relationship between the country size as measured by GDP and trade volume, but also that there's more trade within Canada than between Canada and the United States. As if you compare at gravity 1, that the amount of trade is 1,300 million US dollars. And you can compare that with the previous figure. So if you have gone back to the previous figure, you can see now that at the same level of gravity, there is more than 13 times the volume of trade in terms of US dollar within Canada and between Canadian provinces than between Canadian provinces and US states. So this suggests that on the one hand, that indeed there is this positive relationship. The higher the gravity, the more trade. But to explain the level of trade, there is something else that needs to be accounted for to explain why there is such larger amount of trade within Canada and Canadian provinces than between Canadian provinces and United States. So if trade across borders happens less than within countries, there must be some sort of barriers to trade between those countries. And these are called border effects, which are factors that make it easier or less easy or more difficult to trade goods between countries rather than within a country. And these border effects might be partly the explanation for the much lower trade between the United States and Canadian provinces than within Canada and between Canadian provinces, which include things such as tariffs, which are taxes imposed on imports, or quotas, which are limits on the number of items allowed to cross the border, and other administrative rules and regulations affecting trade, including the time required for goods to clear customs, and these are delays. Other geographic factors, such as the countries sharing a border or not, also matters. In addition, there's factors such as language and other cultural factors that have an effect that might trade more difficult or less difficult. So if there's differentiation in the product market and a technology defined by not constant but increasing returns to scale, there are gains from trade that exist in the form of lower prices and increased variety that did not exist in previous models. The model of monopolistic competition suggests that trade can occur between countries even if they are identical. And this is the main, if you like, takeaway, in addition to the gains from trade that are of a different type of the Ricardian and the Hexagon model. The fact that the countries are identical here implies that countries can be identical in terms of factor endowment or also in productivity. Nonetheless, they will do trade in this model of monopolistic competition. There is trade within the same industries across countries, so there's intra-industry trade because there's a potential to sell in a larger market. When there is an inducement of firms to lower their prices below those charged in the absence of trade. This is one of the benefits. And trade occurs because although the industries are the same, the market is larger. The firms that exist in the industry, however, are reduced, but the remaining firms increase their output and average cost falls. And these lower prices for consumers in the importing country are the other benefit next to increasing variety of products. So higher product variety and lower prices are the gains from trade in this model of increasing returns to scale and monopolistic competition. However, there is some costs of reduction in employment by workers losing their jobs. And we looked at NAFTA, the short-run adjustment accords that are resulting for United States, Mexico, and Canada, and the long-run gains. And one of the applications of this monopolistic competition model is the gravity equation. The equation suggests that the countries which are larger or closer, the greater the amount of trade they will engage in. So a final word on why the gravity equation is indeed an application of the monopolistic competition model, in that we have seen that a firm would like to also export and take advantage of the market abroad. And if that market is very far or that market is very small, there might not be a lot of reason for the countries to engage in trade in the same industry. So this is, if you like, a inverse explanation of the lack of trade. On the other hand, if the country is very large, although far away, or very close, the market that the monopolistic competitive firm can take advantage of abroad will be more attractive if the market is large and if the existing firm in the home country is also large, so it can serve that market. Alternatively, the same reasoning applies if these markets are very close to each other, suggesting that there might not be a lot of transport costs to serving that market abroad if it is quite proximately close. So that is the sense in which the gravity equation is closely linked to monopolistic competition.